Markets pull back, earnings, tensions, and the calm before the storm. Hey everyone, welcome back to PyUncut Investing Insights, where we cut through the noise and get straight to what really matters in markets. Today's episode is titled Markets Pull Back, Earnings, Tensions, and the Calm Before the Storm. After weeks of record highs, global markets finally hit a speed bump. Stocks stumbled, gold crashed, and traders started asking, is this the beginning of a correction or just a breather before the next leg up? Let's break it all down, from tech earnings jitters to renewed US-China friction and what you should watch next. The week that broke the streak. It's been a choppy few sessions for the major US indices. The S&P 500 slipped about 0.5%, the Dow Jones fell more than 300 points, and the Nasdaq Composite tumbled close to 1%. That might not sound huge, but after months of upward momentum, even a small drop feels like a shift in sentiment. So what triggered it? Well, it wasn't one thing. It was a cocktail of mixed earnings, rising dollar strength, and renewed trade concerns that suddenly reminded investors, hey, risk still exists. Let's start with earnings. The earnings puzzle, bright spots and warning signs. We're right in the middle of earnings season. Most big companies have reported solid numbers so far, especially in financials and energy, but tech has started flashing yellow lights. The biggest shocker came from Texas Instruments, the analog chip maker that's often seen as a bellwether for the entire semiconductor supply chain. Their latest guidance came in weaker than expected, and that spooked the market. When Texas Instruments says demand is softening, it's not just about calculators and sensors. It's about how healthy industrial spending, consumer electronics, and auto manufacturing really are. That's why semiconductors are like the canary in the coal mine for the broader economy. Investors took that as a cue to lock in some profits, especially in names that had run up massively during the AI boom. Think Nvidia, AMD, and even smaller chip suppliers. Meanwhile, Netflix's latest subscriber numbers also disappointed. They added fewer users than expected and hinted at slower growth going into next quarter. Combine that with Tesla's cautious tone last week, and suddenly those growth at any price trades are looking vulnerable again. The market feels like it's asking, is this as good as it gets for tech earnings? The trade tension revival. Now let's talk geopolitics, because it's back on the radar. Reports surfaced that the U.S. may tighten semiconductor export restrictions to China yet again. That's part of Washington's ongoing effort to limit access to advanced AI chips and manufacturing tools. Beijing responded, predictably, with its own warnings, saying such moves will undermine global supply stability. Translation? Trade War 2.0 could be quietly restarting, this time focused on AI infrastructure instead of steel or soybeans. And here's why that matters for investors. Every time there's new tension between Washington and Beijing, it disrupts supply chains, pricing power, and global confidence, especially in sectors like semiconductors, EVs, and rare earth metals. Even if no tariffs get announced, just the threat of escalation is enough to make portfolio managers reduce risk exposure for the week. So, in a sense, the pullback we saw wasn't panic, it was positioning. Gold falls, dollar rises, a macro signal. While stocks were pulling back, something even more surprising happened in commodities. Gold dropped nearly 5% in a single day. That's one of its steepest falls in years. Usually, when stocks fall, gold rallies. It's the safe haven. But not this time. Why? Because the US dollar surged as traders bet the Federal Reserve will stay cautious about cutting rates too early. That strong dollar put pressure on gold, silver, and oil and reinforced the idea that we're in a risk recalibration moment. In plain English, markets are digesting months of optimism and realizing that maybe, just maybe, things got ahead of themselves. So what are smart money doing? Well, institutional investors aren't panicking, but they are rotating. Money is flowing out of overbought tech names and into more defensive sectors like healthcare, consumer staples, and dividend ETFs. And bond yields have also ticked up slightly, suggesting that investors are looking for safety and income again rather than pure growth. And if you zoom out, this fits the pattern of what we've seen in every late cycle phase. Markets climb on hope, pause on reality, and then resume when fundamentals catch up. We're probably in that pause stage right now. So what's next on the radar? Here are 3 things I'm watching closely. 1. Earnings from big tech. Tesla, IBM, and Meta are up next, and their forward guidance will set the tone for November. 2. The U.S.-China narrative. If either side walks back their rhetoric, expect a short-term relief rally. But if new sanctions or restrictions appear, brace for volatility. And 3. The Fed's language. Any hint that rate cuts are coming sooner could reverse the dollar's strength and lift risk assets again. This is where macro meets micro, where company numbers meet global politics. And for investors, it's not about predicting the next headline, it's about staying diversified, liquid, and rational. Closing thoughts. The calm before the storm. When markets have been up for so long, even a 0.5% drop feels dramatic. But here's the truth. This pullback might actually be healthy. Corrections shake out the weak hands. They remind us that investing isn't about chasing momentum, it's about staying power. As Warren Buffett once said, you don't find out who's swimming naked until the tide goes out. Well, this week, the tide pulled back just a little, and we're starting to see who's been overexposed. So, stay balanced, keep cash reserves, and remember, corrections aren't the enemy, they're the price of admission for long-term gains. Thanks for listening to PyUncut Investing Insights,